Good afternoon, ladies and gentlemen. It is October 21st, 2022. My name, of course, is Robert Rayburn here at Life Pro Asset Management, and we are certainly grateful that you could join us today. And we do have a lot to talk about. It's been a busy year, it's been a busy quarter, and so far in October, it's been pretty hectic. And when we look at the market this week, it's been volatile. And I'm sure for those of you who've been invested in the market this year, that is par for the course. And, for us, having a more defensive posture, net short the market, what we've seen is the first couple of days, we saw some short covering the Wednesday and Thursday sessions. We saw strong down sessions in terms of markets selling off. And then today, we got a little bit of what we call BS sort of fluff story out of the Wall Street Journal talking about how the Fed is looking to do not 75 and 75, but 75 and 50, so they can do 25 in 2023. And suddenly we're back to the pivot. This is sort of like a Monty Python skit. Every 2 weeks we have another play of the pivot. And I think it's important to remain disciplined here. It's important to say, listen, at the end of the day, what has changed? Has the economy gotten better or worse in terms of rate of change? Rate of change, things are continuing to slow. We're going to go through that today. And then, of course, has the Fed begun to cut interest rates? And the answer to that, of course, is no, because inflation's sitting at 8.2%. So that's where we're going to start off today. The title of this week's presentation is The End of Free Money, right? We're going from that 0% and money printing regime to the end of quantitative easing and toward a high interest rate regime. And so we have to position portfolios as such. And we also know that the UK provides a great template as to what is likely, in our opinion, to happen as the EU and the US and eventually even Japan wind down their quantitative easing programs as forced to by inflation, which is private investors have to endorse government spending programs. And in the UK, we saw the ultimate casualty, which was their prime minister. And the prime minister there, Liz Truss, had to resign because they tried to cut taxes, they tried to spend more, and the bond market said, no, no, no. And unlike in quantitative easing, when the central bank can print money and buy those bonds and provide cover for central governments, that's not available anymore. And so we think that at the end of the day, the UK is sort of the appetizer, while the EU, the US, and Japan are the main courses. So this week, we're going to walk through some of the short-term trading conditions of the market, assess that second derivative of economic growth. Is rate of change accelerating or slowing? And then ultimately review the impact of quantitative easing by the Federal Reserve. In terms of technical support, one of the reasons we've seen this up and down, this chop for the last 2.5 weeks is we are at very, very long-term key support levels. And we can take this chart all the way back to 2009, 2010. That 200-day moving average has been 200-day weekly moving average has been 200 weekly moving average has been very, very key support for this overall market. And certainly if we were to broach that, we think that would be some sort of waterfall moment. But again, these are key levels to keep an eye on here. That's anywhere from 36 to 3,800 is the chop. A solid break under 3,600 definitely would represent a new bear phase of this market. Now, in terms of portfolio protection, after last week, what we saw are those implied volatility discounts started to open up. In other words, future protection is cheaper relative to present protection. And when we see that, we want to up our hedges. In other words, clients, investors, portfolio managers, you name it, they're getting a little lackadaisical. They're starting to short cover. They're starting to chase a false rally, in our opinion. And so when you see that, you start to see these discounts open up in the hedging market or in the options market. And that's where we want to step up the hedges. So when protection becomes expensive, we kind of want to lower or rotate those hedges to cheaper areas of the market. Or as protection becomes cheaper, we want to increase those hedges. And we can see here, the implied vol premiums did come back down into that pink zone, which is the discount. This chart was put together by Hedgeye, a great shop that we do some work with, and absolutely love their research. Now, in terms of that rate of change, just a chart here that I put together, this is your existing home sales. Should be no surprise to anyone, especially if you're in the house for the market, like ourselves, our family. The rate of change is decelerating, and what we see here is after a big strong period of growth, by obviously low interest rates and quantitative easing, we're seeing that strong deceleration to the downside. If we look at the American consumer, we see the same impact, right? Obviously, in 2021, with all that stimulus money, we had that sugar high. So it was natural to expect that this was going to come down. But what we've noticed here is after that 9% growth, we take another step down and we've decelerated all the way to 0% growth year over year. So a strong deceleration. And when we look at overall incomes for the US consumer as adjusted for inflation, right? So we always hear about how incomes are growing 4, 5, 6%. You have to adjust it for inflation, right? So if you made $100 and now you make 106, but inflation's at 110, or those goods have increased by $10, you're actually making less in real terms. And that's what we see here across the board, is that Americans, when adjusted for inflation, are making less. And we think that's going to continue to have a drag on the overall economy. And one slide we don't have in here this week, but I did want to speak to before I get to this balance sheet unwind, is that we certainly are starting to see it in earnings. American Express took up a lot of those non-performing loan assumptions today. We saw an awful quarter out of Snap as advertisers pull back their budgets. We saw the same thing in the chemical space this week. So across the board, we're seeing very, very poor earnings. Whirlpool had the guide down. That stock's been a disaster. WD-40, right? Household name there. Again, cut numbers down double digits on that number. So we're starting to see the earnings story play out. It was a little bit slow there for a beginning, but now starting to accelerate that story. In addition to that, we are starting to see the balance sheet unwind, right? Since 2008, the Fed has purchased $7.8 trillion of US debt, providing a cover for that huge deficit spending we've seen over the last 12 years. As that is pared back and eliminated and reversed, someone has to finance the US deficit, and it's the private market. It's private investors. And likely private investors, unlike the Fed, are going to say, we want higher interest rates for that risk. Really important. And of course, when we look at the overall market, despite the strong push up in interest rates. Now, I will note, despite this story in the Wall Street Journal today about the so-called Fed pivot and slower interest rates, yields are flat today. They're not down, right? So that should tell you something about what's actually happening underneath the surface. So, despite crossing that 4%, most strategists on Wall Street are still positioned for less than 4% on the overall 10-year yield. In fact, very few, only 2 strategists see it north of 4.5. So where's the pain trade? The pain trade, in our opinion, is higher from here in terms of interest rates. Now, history doesn't always repeat itself, but it certainly does rhyme. This is the XHB, this is the Home Builders Index. Again, strong breakdown here through key support, tying into the overall macro backdrop story that we've been communicating here over the past few months. And then, of course, global accountability, right? As QE ends, it's not just the US, it's not just the UK, but it's Germany, it's Japan, it's China. All of these countries are being held to account for how they are operating their fiscal house. We can see here 2-year German interest rates hitting cycle highs. And then, of course, China CDS, something that not too many people here are talking about, but it did pop up on my screen here. Credit default swaps. This is protection against the default of sovereign bonds. So when the number goes up, it implies the risk is higher. When the number goes down, it implies the risk is lower. We've seen a big blowout here over the last couple of weeks, and in particular, the last week or so. Again, at 114 basis points, you're still talking about a pretty, fairly lower, I would say kind of an average level from a low level. The US is about 30 basis points by comparison. Italy's at 170, which is considered approaching that stress zone. So I think this is something to watch, right? This is a big daddy, number 2 economy in the world. So again, we want to be careful. So we do believe at the end of the day that the events in the UK are an appetizer to what may ultimately occur in the US, Europe, and Japan, which is the return of those bond vigilantes, the return of accountability as it relates to fiscal spending. And where do we see that reflected? In the interest rate market as interest rates are pushed higher. So we are pricing around hedges. Pricing around hedges become more attractive, I should say, and that macro backdrop does remain firmly negative. So, the margin of error is definitely to the downside. Interest rates are grinding higher across the globe despite Monday's rally. And then, of course, investors are beginning to take out protection against not just corporate debt, but also sovereign debt. So that's what we got for you this week. 888-543-3776. If you have any questions, please feel free to reach out to your advisor and have an absolutely fantastic week. Talk to you soon.